Okay. Hey, Mike, nice to meet you. Thank you for being here. And why not give our readers and viewers a quick intro to you?
Cool. Well, yeah, CJ, thanks for having me. I've been around in the real estate vicinity for, over a decade, first as a broker and then was an acquisitions director for a private equity company buying apartment buildings, 50 to $100 million. And, utilizing the 1031 to compound and expand our portfolio. And so today I'm the VP of Growth at 1031 Specialist. We're a qualified intermediary. We help investors facilitate their 1031 exchanges, which means they don't pay a dime in tax when they sell their property and buy a replacement property. And, we've got the very hard goal of trying to make 1031s more relevant and, have more investors utilize it because, in my opinion, it's an interest-free loan given to us, from the U.S. government, and I'm not sure why more people don't use it.
Well, I will say that as a marketer and head of growth for a 1031 firm, you got a tough job. It's not you are not selling great. You're not Whole Foods or a shoe sale. You have a tough job trying to explain and market a concept like 1031. It's not something that people wake up in the morning and say, you know what, I got to do a 1031.
Yeah, and honestly, like it's kind of bizarre. It's we're trying to market it and simplify the information so it's easily digestible and kind of 2024 branding. But the real problem, CJ, is like it's not even taught at the licensing level. Like there's maybe 14 words when a real estate broker goes to take their real estate exam to get licensed about 1031s or DSTs. And so the problem really stems from lack of education for a lot of people. And the only way people are aware of 1031s is if they have a client doing them, or if someone has told them in their, center of influence that, hey, maybe you should explore doing one.
Very interesting. I think it's a great point. We haven't even started the interview, and you already made a great point about education and the fact that, yeah, I don't understand how 1031, in order to do well by their clients, how real estate brokers, that's not mandatory education. I don't understand it. I did too. I actually, at the same time, I used a QI, qualified intermediary. We also had a QP. It was quite a complicated, and we had to then take the boots. Well, we'll get into it. Why don't we use this as a jumping off point, and I'll start the questions because really interesting. I find it interesting, and I also find it interesting that not more people also find it interesting.
Yeah.
You ready?
Yeah, I'm
you
ready.
To go?
Yeah.
All right, let's start really general. Explain what a 1031 exchange is in simple terms. Let's do a crayon animation explainer video, and how is it such a power in that explanation? How is it such a powerful tool for new real estate investors looking to build long-term wealth?
Yeah, no, I think it, in the most simplistic terms, CJ, a 1031 exchange is a swap of one investment property for another investment property without paying tax. There's this, term called like kind that people get really confused, but the reality of it is like it's any investment property for any investment property in any city in any state in the US. And actually 1031s have been around for over 100 years. And so I'm going to break this down even simpler for the viewers out there. Like a 1031 exchange is just like any other normal real estate transaction, except for two key differences. Number one, you have to use something called a qualified intermediary, like my company 1031 Specialist, which is an independent third party mandated by the IRS to facilitate someone's 1031 exchange. They in turn do three things. They educate the client. They make sure that they get the tax benefit. And from a compliance standpoint, they get all the documents needed to turn into the IRS, called an 8824 form at the end of the year. And finally, we're not the bank. We don't hold the funds, but we partner with a publicly traded institution that protects and directs, protects the funds during the transaction. And number two, the other point is, as an investor, you cannot take constructive receipt of the funds. So at closing, you cannot have the funds hit your bank account even for a second, or the IRS deems that possession. So what qualified intermediaries do is help the investor set up a segregated trust account in their name, their personal name, or their entity's name, whatever's on the property that they're selling, in order to have the funds go there for the duration of the transaction. And so Since we're into it already, there are a couple guidelines to 1031s. Number one, you've got 45 days from closing of the sale of the property that you're selling. It's called the relinquished property, to identify up to 3 properties as a replacement property, and then you must close on the transaction within 6 months or 180 days. So that's from a simplistic view of how the 1031 really works.
So I'm going to get back to that, because my next question was, you just preempted it, was first and most critical steps. But I want to say something about like kind. And this is from personal experience. When I was selling, we sold at a large capital gain for industrial land. It was a gain of more than $15 million. And we wanted to 1031 into 2 replacement properties. So one thing we will get, the boot, which is also known as the gain, it had to be split, and there had to be 2 accounts set up, because the investor, or in this case, in any case in 1031, you're both a seller and you're a buyer. You're selling real estate, right? You're a seller of real estate, and then you're a buyer of real estate. Also,
Yeah.
as an investor of real estate. So you're a seller and a buyer. What you said is take constructive control of the funds. We can't touch the money. That's really it, right? We cannot touch the money when we sell, or even when we buy. You're our straw man. You're our IRS dictated straw man, right?
Yeah, we're the facilitator, right?
Facilitator.
So, we like to say we kind of facilitate the transaction. It's really simplistic, and I think a lot of people overthink like what a 1031 exchange is. Like, think about the home buying process for a second, CJ. Like, it is almost identical to the home buying process. When you're going to buy and sell your home, typically you put your home on the market and then you start looking for another house to purchase, right? It's almost the exact same thing with a little bit of a different timeline, but people are under the gun and under pressure to find a home, a replacement home, if they've put their property on the market and someone makes an offer and they get under contract, right? So I think for most people, it's all about planning and planning ahead, and we can get into that a little bit later. But like, this is a great tool to help compound wealth. And the real purpose of the 1031 is, think about it, with more equity, you're able to buy more properties that generate more depreciation, more cash flow, and ultimately can generate more wealth faster. So that's really the point of a 1031.
So when you say more equity, that means you're not paying 15 or 20%, depending on the term of the gain. You're not paying that to the government. You have that 15 to 20% of the gain that would have gone to the government in taxes. You have that to buy and invest in a larger either home, I like your analogy, or investment property. Let's jump in the next question. So we've answered some of this, but I'm going to be specific. What are the first and most critical steps to take when beginning the 1031 exchange process?
Yeah, so you definitely need to engage with a qualified intermediary. So you cannot close on a property and then all of a sudden decide to do a 1031 after you close. That is the biggest thing that we get calls daily. Hey, I just closed last week. Can I do a 1031? Well, no, people just aren't educated. So what we always say, CJ, is plan ahead. And so while you're marketing your property with the broker, you should be looking for replacement property. You can actually, make a short list yourself. You can put a property under contract, but the clock doesn't start until you sell the property that, that's on the market, right? And so a lot of times folks will call us and say, hey, it's Monday, I'm closing on Friday. Which is totally doable. It happens all the time. But then they feel the pressure a little bit more because now they're under the gun from a timeline perspective. Yep. And just so the viewers know, CJ, like the deadlines are firm. So it doesn't matter if the 45th or 180th day are on Thanksgiving, like tomorrow, a Friday, a Saturday, a Sunday, or a holiday. Those deadlines are firm. So that's pretty important.
Yeah. So it really is lining up that timing. 6 months once the clock starts. In fact, it's interesting. A lot of the brokers, Jones Lang LaSalle, CBRE, Newmark, right on their intake forms on their websites, or for any property that they're selling as investment property, there's a question: are you in a 1031 exchange? And I think that's to let them know that a clock is ticking.
Yeah, I mean, look, I think, there's a general narrative out there, CJ, that like 1031 buyers overpay because of that clock.
I wasn't going to say that, but
yeah,
yes, as a real estate guy, that's the best investor you want.
Yeah, but it's kind of a false narrative, just because like as a 1031 buyer or seller, like you don't need to tell anyone besides your trusted advisors, your QI, your team, because think about it, right? Like if you're exposed and saying, hey, I'm in a 1031, or hey, the seller is going to do a 1031, you're actually leveraging against yourself, right? So we actually recommend people to not disclose that they're in a 1031. There's no law in the IRS that states that you have to disclose it, even on the contract. So,
interesting.
Yeah. So a lot of people just mistakenly put their, oh, I'm in a 1031. And then obviously, like the people who don't plan, tend to find themselves in situations that aren't favorable. But I will add this one thing, like we always recommend, like, do not do a 1031 or buy something. Do not let the tax tail wag the dog. So if you're just going to purchase something to avoid paying, taxes, it's better to just opt out of doing a 1031 and just pay the tax. And you said something earlier, CJ, like it's really 30 to 40%, taxes that someone's liable for. It's not just federal capital gains, it's state taxes, which in California could be like 13.3%, or Florida and Texas could be 0. There's also something called the net investment income tax for higher earners. That's another 3.8% tax rate. And then there's depreciation recapture tax. So if someone is depreciated, their building and doesn't do a 1031, like they could be taxed at a maximum of 25% of the amount of depreciation claimed on the property. So there's a bunch of different things that, and doing a 1031, you can defer all those taxes, right? So,
I forgot about
people just aren't even aware of that.
I forgot about our California deals, and we got that tax. That was a little bit of a surprise when we did it, because we did it in a rush. It wasn't a 1031, but we did it in a rush. And I said, "Wait, what? What's that tax? Who told me about tax?" We work nationally, so we have to know every single tax municipality, tax environment, and that one was a shock in Cali, in California. So, what are some of the common mistakes that first-time investors / sellers, 1031 exchangers? What are their common mistakes that you've seen?
Yeah,
and how to avoid them?
Yeah, look, I think again, it just comes down to planning. I think there's a lot of other myths out there. Like just because you're selling a multifamily property doesn't mean you have to buy another multifamily property. Like the like kind thing trips up a lot of people. Like, a lot of people think like they don't have any options, but the beauty of a 1031 really is you have infinite amount of options. You can go from, an apartment building to an industrial park. You can go divest from an office building, which we're seeing right now, and buy a single family rental portfolio, right? Like there's almost infinite options, and a lot of people use this strategy to reallocate the geography of, their portfolio. So we see a lot of people coming out of California, which is a really high appreciation market with no cash flow. Then they pick up some stuff in the Midwest, and all of a sudden, they have a ton of cash flow, right? And so, I think from a mistake standpoint, it's, do the hard work up front and just get educated. I mean, not to plug ourselves a little bit, but like, we've got some of the best educational materials out there to really simplify the process. Everything.
That's how Anwar found you. That's how Anwar found you. Yeah, so it works.
He did. And I'll just say this because I think it's interesting to the time that we're living in. About 9 months ago, we created, we saw the way technology is going. I'm sure everyone on this podcast will know about, ChatGPT. We actually created our own 1031 AI GPT tool, and we hired an AI engineer to build it. We battle tested it with some of the top tax structuring attorneys and CPAs in the country. But here's the real kicker, guys. We fed this thing a data set of 808,000 words of 1031 papers, IRS revenue rulings, pretty much the tax handbook. And so now any client, any broker, any partner can get great information in 10 seconds or less. It's in a chat tool on our website, or they can email AI at mr1031.com and get an email back in a minute. But the point being is like, it's hard for all of us today in this world of instant gratification and constant distraction to get good information, and no one has name recall of anything, right? And so we decided to make it a great tool for people. So any scenario, any question, like, it can answer. So we're trying to make it super, super easy for people.
Ingenious. By the way, we're launching one for personal wealth management, millennial wealth management in 1 month. We did the same thing. We did a million words.
Yeah.
Because it's a very broad topic, personal wealth management. There's like a whole curriculum that we had to feed information and train it. Amazing that you did that. And actually, because your topic is so focused, it actually would perform really well, knowing what I know about building a small language model, whether it's a chat-based, like you might be referring to, or an actual LLM, which is a large language model. Ours is a small language model. I think it's an amazing way to teach yourself, especially when the topic is like 1031 and ping it questions. That's a great idea. So congratulations on that. You also answered my next question about timing. So I'm going to jump and say, what strategies or tools in today's competitive market would you recommend to new investors for identifying, securing strong replacement property? And I'm glad you emphasized the idea of lifetime, because when I did mine, admittedly, and this was a long time ago, before there was GPT or even most of the internet, frankly, it was in the late 80s. I was stuck on the like kind thing too. And then I met AQI, just like yourself, and they said, yeah, no, you don't have to go back into the same medical office building or back into same dirt, industrial land that you just sold at a great profit. You can go, the opportunities are infinite in all commercial real estate. So I'm glad that is the one takeaway I think is really important, is to throw away the idea of like kind, sell this kind, and find the exact kind, because that almost never lines up.
Yeah, and look, I think you asked the question, and I think I heard it correctly. Like, what are the planning solutions to identify, a property and have a successful exchange? Well, number one, I think the most successful people are the family offices and institutions that actually go out and do this and close on the same day and line it up, or they even do something called the reverse exchange, and they buy their property first and sell a property in their portfolio. There's a little bit more risk in that market today, but
hold on with that. I want to focus on that. That's really interesting, because that solves a lot of problems, and I wasn't aware of that, of a reverse exchange.
Yeah, I mean, a reverse is the opposite, right? So the investor buys first. They have to be really well capitalized. Most investors can't do that because they need the equity,
right.
to buy the replacement property. Yeah, exactly. And then they choose, and then an investor chooses a property in their portfolio to sell it within 180 days. But it's a little bit more complex than that. There's a lot of different steps that are involved. And I think, just for the sake of being simplistic on this podcast, it's kind of an introductory course. Like, most people won't be doing a reverse exchange. It's really meant for, people like family offices that are well capitalized. However, I will say, going back to the planning, CJ, like, think about the mechanics of when you're putting your property on the market. You can actually do 5 different things that really helps you plan and make sure that the 1031 is successful before the 45-day clock even starts. So before you even sell your property, you can do the following. You can have a broker shortlist 10 properties for you. You can actually go out and identify your replacement property or properties. You can enter into an option contract to buy your replacement property. And
harder, a little bit easier these days, but when the debt was like running like water, that would have been pretty hard. But now maybe you can do an option contract.
Yeah, I mean, and the most important thing is you can actually put your target property or properties under contract, assuming you don't go hard, of course, because you don't want to put your money at risk. And then, obviously you can do the reverse exchange, but you still have a little bit of risk because you'd have to sell something in your portfolio to satisfy it. But I think the thing is like, planning really is a solution for a 1031 and like most things in life. And If you think about it, like the alternative to not planning is paying 30 to 40% of the taxes. So if you treat this like a full-time job, you're going to be saving hundreds, if not millions of dollars when you do a 1031 exchange. And I think the real thing, like Charlie Munger said, is you don't want to poison, the compounding well of tax-free compounding. And it's a really, really, really beneficial tool that a lot of people just, they don't set up a plan for it. And I'd rather, as an investor myself, start looking to see what's out there versus just put my property in the market if I don't have to. That way I can line myself up for a successful exchange.
Speaking of that compounding, I had another personal anecdote. Is one of our investors in the multifamily office I ran before NOYACK, they told me the story that they learned way back when, again, 70s, 80s, when it was still a little bit newer to the larger commercial real estate investment community. And they did a 1031 exchange. Now, he was much older, and it's years and years and years that had gone by. And he said, I still haven't paid that tax. Why? I did 3 or 4 1031 exchanges, and I just kept rolling over the taxable gain into additional 1031s. He's like, I'm going to die and never pay that tax except actually as the estate. But they already had a plan for that too.
Yeah, I mean, CJ, this is another myth. Like, well, why should I do a 1031? Eventually, I'm going to have to pay the taxes, right? Well, really, the grandmasters of, in the top real estate families in this country utilize the 1031 exchange strategy. It's kind of called swap till you drop. And the way it really works is, when your time on earth is up, okay, and your kids inherit your portfolio, or whoever inherits the portfolio, they'll get a step up in basis, and the lifetime of appreciation that you made happen, they won't have to pay a dime in tax. Like, think about that. And so that is so powerful. And a lot of people don't realize that because they're either miseducated, they clearly don't know. But that is what gets passed down from generation to generation. And, you're talking hundreds, if not billions of dollars, have been utilized this way, right?
Yep. So there's tax deferral, and it's great. We love tax deferral. But what you just described is, unfortunately, death has to occur for it to happen. But that's actually sort of tax elimination, because by swapping until they drop, i.e. dead, that step up in basis eliminated a portion of their original capital gain tax.
Yep.
That's the only way 1031 I know in all tax strategies where you have tax elimination, not tax deferral or tax transformation. Tax elimination.
Yeah, I mean, what other tool out there is like this, right? And in the real estate world, like, I'm trying to, and I don't want to use this term, like, but I want to make 1031s, definitely more relevant. I want them to, here's a stat for you guys. 1 in 7 commercial transactions are 1031. So like 14.
Is that right?
Yeah, 14.
That's way higher than I thought. Way higher.
It should be 1 in 3 or 1 in 2, because endowments, REITs, pension funds, certain types of syndications
they don't have tax
1031s.
Yeah.
And so, like, why isn't this being utilized more? And it's just because people simply don't know about it. And that's really the issue. And so, we're trying to mass educate from the licensing level, from the brokerage level to the investor level. And we've got our, we got to chop a lot of wood in the next, 10 years to make sure we get to that point.
I'm all in on the education. I agree with you. That has been a big inhibitor. A lot of people don't know. When I did it, and I'm a real estate professional, even since I was 12 years old, really doing real estate investment with my father and solo. I didn't know when I did that first transaction in the early 90s, late 80s, I didn't know there was a lot of misconceptions, like kind being one, didn't understand the whole QI, QP role. I will say this, I'm going to push back on one thing. I agree with everything you said, but we're leaving one thing out that comes from that experience as well. And I've done a few now. There is a cost. I wouldn't call it, I mean, I love the gain deferment, but I wouldn't call it super efficient. Do you agree or disagree?
Yeah, I mean, look, like there are certain times you should do a 1031. There are certain times you shouldn't do a 1031. Like I think as an investor, like if you can't replace the cash flow or the cash on cash, like there's really no reason to do a 1031. Or if you're
Right.
trying to level up, right? You buy a 4 unit, it performs well, you take the equity, and then you buy a 12 unit or whatever, right? So, I think just in general, again, people just are conditioned the wrong way right now in terms of how they think about it. Like the fee to do a 1031 exchange is very, very low. It's, our fee is $1,195. So it's not a cost thing. I think it comes from a
Well, the
planning.
lawyers, though, the lawyers charge a lot more.
Well, they don't need a lawyer to do a 1031. Honestly,
Really?
I mean, New York is, and out East, they have a lot of attorneys that do this stuff. They do it part-time. But I think for us, like we just specialize in 1031s all day. And, it's a very de minimis fee that plays a pretty important part in the transaction. And so, yeah, look, I think when someone wants to do a 1031, like they really have to think about like if this makes sense. But, let's just say the 1031 gets eliminated, which we don't think is going to happen in our lifetime. There would be no incentive for a lot of people to trade, their real estate. And so I personally think that it'd be a huge detriment to the industry. And, it's a fee business. Brokers, investors, lenders, there's, us, a ton of other people make money off of the transaction and the fees. And if you're going to, eliminate the 1031 to get rid of, the tax benefit, like a lot more people would have no incentive to trade. And so I don't think that's going away, at all.
The context that we've been doing is that you have a single investor making a sale and redeploying that capital gain in another property. What if you are a not limited partner, but you're a member of an LLC, you're a minority member, the managing member of that LLC decides to sell, hopefully you're friendly, and then they listen to your timing. What are the steps if you have a LLC interest but are not the controlling interest?
Yeah. So you either have to do it all together, so the same LLC has to swap into the next property. However, there is something called a drop and swap, which is used when dealing with partnerships with multiple members. And typically what happens is before, a long time, typically before closing, and this is up to the tax structuring attorney. Like we're not CPAs, we don't give tax advice, but typically the partnership is, or the LLC distributes the property to the partners or members and creates something called a tenant in common. And that typically means that instead of the property being held by the partnership or LLC, it's now held by the individual members in their own names, based on the percentage of ownership that's put on the deed. And so, then each member can independently exchange their undivided interest in the property for a separate replacement property under the rules of a 1031 exchange. So this is really common.
Really? It is a tick. I know what a tick, tenant in common. They do that. So that's an extra step, basically. You go from an LLC to a tenant in common ownership interest, a tick, and then you exchange.
Yeah, think about it. Let's say the three of us are in an LLC, right? The property performs really well. CJ, you and I want to continue to go on and do a 1031, but Anwar wants to cash out, right? Just because
Anwar always wants to cash out, by the way. That's very appropriate, very appropriate example. Always wants to cash out.
And so well, I don't want to cash out. You don't want to cash out. Like you don't want to pay the tax. Like you want to keep it rolling. And so that's when you set up a tenant in common, and essentially you'll be able to go your own separate ways at the sale. So we see that a lot, with a lot of partnerships. As much as we like to think about it, like partnerships lasting forever, lifestyle circumstances change, and this is a great way to maintain the tax benefit and for everyone in the transaction.
So I think this is the last question. I gave you a little heads up that I was going to ask this. Delaware statutory trusts. This
Yeah.
is something that I've actually learned. Again, I was a pretty traditional large scale, fund and multifamily office owner. Even the LLC, even though the numbers were big, they were pretty plain vanilla LLC ownership. Delaware's, and then we did the 1031, which still went from one LLC to another LLC. Delaware statutory trust I learned about 3 or 4 years ago, later in my career. They're often mentioned in connection with 1031s. I know a couple of our fund competitors who have offered up. JLL has a very big, Jones Lang LaSalle has a very large Delaware statutory trust in order to facilitate those people desperate who cannot find a property to. So tell me what you think of Delaware statutory trust and what have you seen in their use?
Yeah. So, typically like a syndication or a regular REIT aren't allowable by the IRS to do a 1031. So basically what a Delaware statutory trust is, it's a legal entity created under Delaware law that allows multiple investors to hold fractional ownership interest in a property. As many as 2,000 LPs in a property. A tenant in common can go up to 35. And so when you're talking at scale here, it's a really great tool. The thing with DSTs, it's probably 10% of the 1031 exchange market right now. I think eventually it'll get to I think eventually it'll get to, 20 to 30% once the wealth management companies kind of get more aggressive and market it to their clients more. But I think here's the rub on DSTs. Number one, a lot of people still want exposure to real estate and they don't want the active responsibility of managing their property anymore. So a DST is essentially a way for them to get all the real estate benefits and become a passive investor. The problem with the DST, in my opinion, is that the fee load is extremely high, anywhere from 10 to 20%, which
that's crazy. That's ridiculous.
It's really ridiculous. And so, there are things I think in the future which will lower that substantially. But, the problem with a lot of these DSTs are, number one, the holding periods anywhere from, 5 to 10 years. It's illiquid, right? So like if you want to get out of it, you really can't. And number two, a lot of these investors that have been having their portfolio for a long time love a sense of control. And there's not a lot of control there because of the sponsor, being able to do that. However, it is a great vehicle if someone wants, exposure to real estate and have all the benefits. But, I think someone has to do their own due diligence when it comes to the type of deals and the type of DSTs that are out there. We typically don't give any investment advice, even though I have my personal opinion on stuff. And so, I always say, hey, ask your representative, ask your broker, ask someone else, because, as a qualified intermediary, CJ, like we like to stay completely independent per, the law. But yeah, I think it's definitely an interesting space, and you just got to be careful because sometimes it seems a little bit too good to be true, in my opinion.
So Mike, it's just you and us here. Tell me what you think about JLL's DST.
Yeah. I mean, look, I think
no one's ever going to watch this.
I think anything that 4% or 4.5% coupon clipper, like, you're getting charged, 20%, 10 to 20% as an investor, which makes no sense. And there's no guarantee, right? So, all
it does is create an easier exit for the 1031, because I don't think we made this clear. So I just want to go back. You're exchanging the gain on the property that you're selling for shares in a fund, a Delaware statutory trust, which is also AKA a fund that you now own shares in. So you own passive ownership of shares in a fund that was exchanged from the gain of your physical asset that you owned into a fund. Now, what you're saying is if the fund is shitty, the DST is still shitty.
Yeah. And you can see the last 4 years, there's been a lot of sponsors in that space not being able to give the dividends that they promised. Right. And so, it's like any investment out there, like, you have to do your due diligence. You have to make sure that it aligns with your investment goals and your strategy. And there's a lot of people out there that, they may have a lot of licenses, but they're not always acting, in the best fiduciary manner, because they're collecting a fee, right? Like that's how they make money. And so you just have to be careful. That's all I'm gonna comment on that.
Yeah, I can see there's a lot more you'd like to say about some of the DSTs. Well, anyway, I'm glad we brought up that hot topic in a 1031 conversation. Last thing, we're going to keep it general. New investors who are like, I'm going to build a portfolio. I'm going to be the master of the universe in real estate. How do you see it fitting into the beginning of building a portfolio? Let's keep it just general and simplistic for the investor who wants to say, I'm going to build a portfolio of something.
Yeah. So you need equity to buy property. And every time you sell a property, if you have to pay 30 to 40% tax left over, you're left with less equity. So let me just break it down for you guys really simplistic, okay? Because I think your viewers will appreciate this slight example that I'm about to give here, just on one single transaction. The true power of a 1031 exchange is really the ability for someone to meet their investment objectives without losing equity to taxation. So I've said this before, but with more money, you can buy larger, multiple, or more productive properties. So let's just say, after you sell a property, you're left with $500,000 in equity, okay? If you're doing a 1031 exchange, you don't have to pay any capital gains tax. So you'll be left with $0 of capital gains tax that you'll have to pay. On that same $500,000, let's just assume that the capital gains tax that you'd have to pay is $65,000, okay? So the equity left to reinvest over when you're doing a 1031 is that same $500,000 of equity. When you're not doing a 1031, it's only $435,000 of equity. So here's where the power really, gets highlighted. Assuming a 20% down payment, this is more residential. Obviously, for commercial, it's really anywhere today from 40 to 50, 55, 50%. But assuming 20% down, just because we're talking about, beginners here, that 1031, doing a 1031 exchange, you'll be able to afford a property worth $2.5 million. That same, if you pay the tax and you're left with $435,000, you'll only be able to afford a property worth $2.175 million. So the single difference in just a $500,000 example is $325,000 of purchasing power. So $325,000 gets you more property, more diversification, more bonus depreciation, and most importantly, more cash flow. So, I hope that provides a really simplistic example on just one small transaction. Now add a couple zeros to that, and you'll see over time, after you're doing a bunch of transactions, how much further ahead you come out in a 1031 versus paying the tax each time.
Thank you. By the way, this is the soundbite. This is our clip that we're gonna promote. It was great because that's how you ladder up. 1031 is the savior of equity.
Yep.
There it is.
Literally. So
literally. Yeah. Savior and savior. Hey, Mike, really interesting. I learned a lot, and I've been doing real estate for 30 years and I still learned a lot. So I appreciate your time. This was great. And let's get education out there for all, even the newcomers, young adults. Let's get them educated.
Great. CJ, Anwar, thanks for having me.
Thank you, Mike. Excellent.
Thanks,
Be well.
guys.